The FTSE 100 index of leading UK company shares is set for its worst month of performance since March 2020. With a resurgence of COVID-19 cases and the risk of a fresh lockdown, with the looming US presidential election, and with Brexit trade talks unresolved, what's coming next for the UK and global equity markets? That's coming up in this video. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice, and in this video I wanted to take a look at what has been a pretty terrible month for the UK's stock market, for the FTSE 100. We've only got about 3 or 4 hours of trading left to go as I record this, and we are on track for the worst month of performance since March, so since the start of the coronavirus pandemic. Assuming that the index remains roughly where it is right now, this month it will be down by 4.9%. So it started October at 58.66, current price as I record of 55.74, so about 4 hours of trading left. That's down 4.9%. Wants to have a look in this video at some of the factors which are driving negative investor sentiment right now. Three things really: COVID-19, the US presidential election next week, and also Brexit trade talks, and we'll tackle them in that order, take a look at what they all mean for the markets and what they're likely to mean as we head into the final 2 months of 2020. So how the UK and global equity markets might perform in November and December. Let's start then with COVID-19, and we are well into second wave territory right now. Been some really interesting developments this week, including fresh lockdown measures in both France and Germany. Looking at some pictures on the news last night of a mass exodus from Paris as Parisians flee the capital ahead of lockdown measures being introduced last night. And the lockdown measures in France are due to last for 4 weeks. They finish on the 1st of December. They're going to be reviewed every 15 days. And when they were first announced a few days ago, I questioned on Twitter whether this was really a lockdown. I asked that question: when is a lockdown not a lockdown? Because you look through some of these measures in the French lockdown, and schools are going to stay open. Universities are going to stay open, but they are encouraging online learning where possible. Retirement homes and nursing homes are going to stay open to visitors. And unlike the first lockdown we saw in France, this time round they are making mask wearing mandatory, so that's a big difference from the last one. They are encouraging working from home, but it's not mandatory, so some offices will stay open. And also parks and gardens will stay open this time round, so that's another difference. However, you won't be able to go more than 1 kilometre from your house, so there are these restrictions on movements, which would explain why so many Parisians apparently last night were rushing to leave the capital, heading off to their second homes in the countryside, because given the choice, you wouldn't want to have a lockdown in a city centre. Given the choice, it'd be far better to be somewhere remote and rural. So that's the French situation. On the plus side, less restrictive lockdown measures should result and should translate into less impact on jobs and on businesses and on the wider economy. So whilst we may see less of an impact on COVID-19 itself from those lockdown measures, it's unlikely to have such a severe impact on the French economy this time round. And in Germany this week, we saw news of another lockdown, another fairly soft lockdown, although arguably slightly tighter than the French one. This one comes into force on the 2nd of November, so on Monday. It's going to last for 4 weeks, but it's going to be reviewed after 2 weeks. The lockdown measures we're going to see in Germany this time round will see bars and pubs close. It will see restaurants close unless they offer a takeaway service. It'll also see gyms, theatres and cinemas close. Unlike in the UK where we have a rule of 6, in Germany they have a rule of 10 for gatherings, but with a maximum of 2 households. Hotels will be closed for tourists, but will stay open for essential reasons. And shops will stay open, but they're going to have a maximum of 1 customer per 10 square metres. So that will dramatically reduce the capacity of many shops in Germany, and of course have an impact on their local economy there. So will these lockdown measures in France and in Germany have any real impact on COVID-19? Possibly. Time will tell. I think what's what's really interesting about any lockdown measures is that the COVID-19 cases, especially when it comes to hospitalizations and deaths, these are really baked in now for the next 3 to 4 weeks. So anything we do today is unlikely to be seen in terms of its results for 3 or 4 weeks, up to a month's time. And that's really because of how long it takes for this virus to spread, for people to become seriously ill from it, and also with this asymptomatic spread which takes place, which is a real hallmark of this virus. People spreading coronavirus without realising they are sick, they are infecting others. So it could take time to see whether these lockdown measures in France and Germany are successful. And of course here in the UK, the government is once again facing criticisms of being slow to act on lockdown measures. Instead of any national lockdown, which ministers appear to be resisting, we're seeing lots of local lockdown measures. And that slow to act criticism of the UK government, I think, harks back to March. Remember the impact of the Cheltenham Festival going ahead back in March. The local lockdown measures, again, could be an effective way of dealing with it, of balancing this need for public health and the economy, but only time will tell. What we've got going on in terms of local lockdowns in England, with 3 different tiers of lockdown, is Nottinghamshire now entering the highest tier, Tier 3, and also from Monday, West Yorkshire. When West Yorkshire goes into Tier 3, it means that 20% of England will be subject to this highest tier, this highest level of risk of restrictions. And Tier 3 restrictions mean you're not able to socialise with anybody from outside of your household bubble in any indoor or private garden setting, and then the rule of 6 will apply to any outdoor gatherings, any outdoor socialisation too. Pubs and bars will have to close in those Tier 3 areas, but they can stay open if they offer a substantial meal service, so if they operate as a restaurant. Seeing schools, colleges and universities remaining open in those Tier 3 areas, and gyms and outdoor exercise classes, organised sports can continue outdoors but not indoors. So some quite strict measures as part of Tier 3, and as I say, from Monday, when West Yorkshire goes into Tier 3, that's 20% of England subject to those strictest lockdown measures. As I record this, a number of people in total in the UK who have died within 28 days of testing positive for coronavirus has reached a total of 45,955, with another 280 deaths reported yesterday. And there's currently 957 patients in hospitals in the UK on a ventilator with COVID-19, of just over 10,000 hospitalised people in total with COVID-19. So we are seeing rising levels of infection, we're seeing rising hospitalisations, rising death levels. We're not yet back at first peak levels, but it doesn't take much of a genius to read the charts and see what exponential growth in these numbers means. We're seeing a doubling of this virus every 8 to 9 days at the moment, and that is going to have a big impact on the case count, on hospitalisations, and sadly on deaths too in the UK. As I said earlier, it takes a while for lockdown measures to feed through into these numbers and to have an impact. So it could be 3-4 weeks or so before these Tier 3 measures we're seeing in England have any meaningful impact on the rate of hospitalisations, on the rate of death. There are some reasons to be positive though. We are seeing some indications that the combination of things really, so firstly the most vulnerable in society having been killed off by coronavirus during the first wave, but secondly more effective treatment regimes, and thirdly a possibly less aggressive virus this time round, having an impact on fewer hospitalisations, fewer deaths this time round in the second wave. So there are some reasons to be positive, but really only time will tell. Turning then to the second factor which is influencing global equity markets and the UK stock market right now, and that is the US presidential election. It is Trump versus Biden. That takes place next Tuesday, the 3rd of November, for the US presidential election. As I record this, Biden is leading Trump in the opinion polls, in the voting polls in the US. But of course, we must remember that last time round, Hillary Clinton was leading Trump by quite a decisive margin in these opinion polls. So we have to be very careful when it comes to trusting the opinion polls. The US electoral system is quite complicated. It's a little bit weird as well. It relies on this system of electoral colleges, where the winner of each state's popular vote gets all of the electoral college votes for that state. I think with a couple of states exception, there's a couple of states that don't use that system, but in the main, that's how it works. And that is why there is so much focus on these so-called swing states, where just a small change in the popular vote can have a really big impact on who receives all of the electoral colleges. And that's why there's so much of an emphasis on the so-called swing states, where just a small change in the popular vote can completely change who receives the electoral college votes. The swing states then make it very important for a Biden or a Trump victory. Which outcome next week would be better for the stock markets? We can look back at history, and history tells us that since 1974, the Democrats have been better overall for the US stock market than the Republicans have. The Democrats have returned an average of 15.4% for the US stock markets a year, and the Republicans 8.6%. Those numbers are not completely fair because they cover the period 2001 to 2009 with George W. Bush, who was a Republican in office, and he inherited the end of the dot-com bubble bursting and also the worst of the global financial crisis. Arguably, wasn't his fault that the global financial crisis took place. It took place on his watch, certainly, but it was probably repealing most of the Glass-Steagall Act back in 1999 and Bill Clinton that could be most at blame for the impacts of the global financial crisis. So those two sets of numbers, Democrats versus Republicans, and the stock market performance during their time in offices, doesn't really give us a fair picture. Overall, a Trump victory is likely to be better for the US and global stock markets than a Biden victory. I didn't think I'd ever say those words, but there we go. However, what the investment markets and investors really dislike is uncertainty. And that's why I think, combined with COVID-19, we've seen a bit of a wobble in global stock markets this week. Why we're seeing increasing levels of stock market volatility, because there is uncertainty ahead of the election next week. It's by no means a certain outlook. And particularly with Trump threatening legal action if it's a close call election, that I think would lead to even more uncertainty and even more market volatility. What about Brexit then? The third aspect of what's going on at the moment with this risk-off environment for equity markets as we head to the end of October. We are at a critical stage for Brexit trade talks, and also in the very short term, a bit of a deadline, and that's because European Commission President Ursula von der Leyen threatened about a month ago to continue with legal action against the UK unless they were able to respond to the EU's claims that they were trying to overrule parts of the withdrawal agreement with this recent bill in Parliament. So that's a very short-term deadline that's coming up tomorrow, and that could influence trade talks quite significantly. It's never good to try and negotiate with somebody if you've got the threat of legal action hanging over you. Otherwise, we think there has been some positive movement recently this week on Brexit trade talks, but there is still a long way to go. There are still many points of differences. Von der Leyen this week said there had been good progress on trade talks. The bits that seem unresolved at the moment seem to be around this level playing ground for trade and also fishing rights. Fishing rights do appear to be the thing that's stopping a trade deal from being formally agreed, along with that level playing ground issue. So at the moment, as things stand, we don't have a trade deal. We are heading rapidly towards the end of the transition period on the 31st of December. That's coming up very shortly, and we are in last ditch territory here. We're waiting for a breakthrough. Best case scenario then for stock markets in November and December as we head to the end of 2020. Well, firstly, COVID-19 cases coming under control, so not seeing a full-on second wave or even a worse second wave than the first one. That would be really positive, I think, for investor sentiment right now. Secondly, a decisive victory for either Biden or for Trump in the elections next week. We don't want to see a close call. We do not want to see protracted legal arguments and legal debates to work out who the president's going to be. That would be bad for stock markets. And thirdly, some movement on Brexit trade talks. So whether that's an actual agreed deal or at least a step in the right direction, positive progress towards a deal. If we see those three things, I think we could see a little less volatility as we head into November. We could see a bit more positivity in equity markets. But of course, the opposite is also true and is also the case. We may well see COVID cases continuing to surge. We may see continued uncertainty when it comes to the US presidential election. And we may see a collapse of Brexit trade talks or even a trade agreement which is not a full trade agreement, some sort of trade light deal. One measure of investment market volatility is the VIX index or the fear index, and it's riding very high at the moment, around 38. It's been well over 30 for the past week. 30 is the level where we look at it and think there is probably market volatility to come. 40 is extremely high, so at 38, which is where it's sitting as I record this, we're expecting more market volatility to come. That's, of course, only one measure of predicted equity market volatility. It's not the only one. but it does tend to be fairly reliable. So some volatility to come. Let me know in the comments down below what factors you think will influence global equity markets as we head towards Christmas 2020. I'd love to hear your thoughts on this. Thank you for watching this video. Please do subscribe to our channel for more videos just like this. I talk about personal finance, investing, the economy, happiness, all sorts of things on this YouTube channel. And until next time, don't forget, when it comes to your money, the more you know, the faster it can grow. Thank you for watching.